So what I've got here is a class action lawsuit document against Grant Cardone personally and Cardone Capital. This document basically alleges that Grant has misled investors and could be facing some serious repercussions. Today I'm going to be delving deep to figure out how it all went wrong. How has Grant Cardone gone from being a billionaire business mogul to being sued for misleading investors and potentially facing some hefty charges? I'm also going to be reviewing this legal document and determining the potential outcomes and how serious the penalties might be and whether Grant might even face some jail time. I'm going to put some timestamps down in the description below because some of you might already know who Grant is and how he got started and how his funds are currently performing and just want my review of the document. But before we get started, if you've got any questions about anything I say today or you think that you might actually be affected, please be sure to leave a comment down below and I'll answer it whenever possible. Also, in addition, everything I say in this video is just opinion and it's not proven facts. I also don't have any inside sources of information and I'm not a qualified lawyer, and anything I say in this video isn't meant to slander the name of Grant Cardone. I'm just simply reporting on recent events. So firstly, who is Grant Cardone and what does he do? Grant is a multi-family real estate investor based in the US. This means that he invests in property, typically larger apartment complexes or just any buildings with more than 4 units instead of single family homes. He also regularly appears in some of Samuel Leeds' videos as he has previously mentored Samuel. Samuel has recently landed himself in some hot water of his own, facing his own class action lawsuit. So I guess you could say that the apple doesn't fall too far from the tree, or the tree doesn't stand too far from the apple. Grant actually started out investing in single family homes, but quickly realised that the cash flow and the return on investment, or the cap rate in America, isn't nearly as good as it is in multifamily property. Multifamily property typically gives him at least an 8% return on investment, and he aims for a 15% or a 16% return on investment, which is frankly a pretty crazy return. He also notes that with multifamily property, you typically don't experience the vacancy issue that you get with single family homes. If you buy one big single family home and your tenant leaves, you've got 0% occupancy. But if you buy a fairly normal sized multi-unit apartment complex with say 15 apartments in it, even if 3 or 4 of your tenants leave, you've still got a pretty high occupancy rate. But Grant Cardone has always been a bit of an innovator. He knew that he could use 25% of his own money and get a 75% commercial mortgage or something around that area. But he realised that actually, if he started a private equity fund, he could get loads and loads of external investment and use that money and commercial mortgages to buy even bigger apartment complexes. And this is how Cardone Capital was born. Grant started his first fund, St. Lucie LP LLC, also nicknamed Cardone Equity Fund 1, with $4.8 million from external investors. In this fund, Grant only bought the best of the best properties, and these investors were accredited investors, as in high net worth individuals that potentially have money to lose if all goes wrong. With this $4.8 million invested, he went and bought some apartment complexes with commercial mortgages as well. He generated around $2.7 million in revenue with around $1.4 million of expenditure and therefore profits of $1.3 million. He returned $600k to investors, about $600k a year, and that's about 13% return annually. Now this is all pretty impressive. With that $4.8 million invested, he could have bought around $19 million of property. To generate $2.7 million of revenue or $1.3 million of profit on around $19 million of property is really impressive. It's about a 7% return on assets or a whopping 30% return on investment. Grant continued his early success with his second fund, Ormond Beach LLC, or Cardone Equity Fund 2. This had $8.3 million, again from accredited investors, and gave a return of about 11.5%. But where it all started to go downhill was in funds 3, 4 and 5, raising $45 million, $106 million and $50 million respectively. This money was raised from non-accredited investors, so regular people like you and I. Grant then needed to use all of this money to go out and buy properties. But $200 million is suddenly a lot more than the $4.8 million and the $8.3 million that he had to throw around beforehand. Especially if he's leveraging these properties all at around 75%, that's suddenly about $800 million worth of properties that Grant needed to find and scoop up. So therefore, I can only naturally assume that the quality of property that he purchased fell. Obviously it's only an assumption and I don't know for sure, But why do I assume this? Well, you can see here that from this SEC filing that Fund 1, he's so far purchased about $16 million of property and generated about $2.7 million of revenues, which is an income on asset percentage of about 16%. Fund 2 generated about $4.2 million of revenues on $31.5 million of assets, which is an income on asset percentage of around 13%. Fund 3 on the other hand only had a 9-month period in 2019, generating around $9.8 million of revenues, and if you prorate that for a full 12 months you get an expected total revenues of $13 million for the full year. On $101 million of assets, it's about a 13% income on asset percentage as well. But in Fund 4 he generated $9 million for the 9-month period, so about $12 million for a full year. But this time it was on $250 million of property, so an income on asset percentage of only around 4.5%. In Fund 5 he generated about $4.4 million of revenues for a 9-month period, so about $5.8 million for the full year, on $185 million of property, so an income on asset percentage of around 3%. Much worse. But as these funds have only recently started life, it's likely that these properties haven't been owned for the full year, and therefore in 2020 and 2021 it's likely that they might receive more revenues and therefore generate more money and a better return. If you're enjoying the video so far, be sure to drop a like down below and subscribe to the channel if you haven't already. Only around 14% of you are actually subscribed to the channel, which is really low. So subscribe, it's free and you can always change your mind and unsubscribe later. But where the problem really starts is with investor payouts. As I said earlier, Fund 1 returned about $600,000 to investors. On a $4.8 million investment, that's a 13% return and really good. Fund 2 returned about $960,000 to investors, and on an investment of $8.3 million, that's a return of 11.5%, so also really good as well. But Funds 3, 4 and 5 only paid out between $700k to $1.6 million to investors, which is only a return of between 1.5% to 3.5%, which is a real problem. Now obviously in 2020 and 2021 the properties would be owned for a full year and therefore would have earned more revenue and would have paid out more to investors. But obviously this year there's been that minor problem of COVID, which probably means that thousands of Grant's tenants couldn't pay their rent. I say maybe because I don't really know if they did or not. But as a result, revenues could be much lower for this year, and Grant actually halted payouts to investors for a good portion of the year, although he has now since resumed those payouts. Accredited investors might be able to see the longer term picture and say, well, returns in year 1 and year 2 were definitely below what was expected, but returns in year 3, 4 and 5 and so on will be better than expected, and therefore will kind of catch up and even everything out by the end of the investment. But non-accredited investors might not really see it that way. If they've been promised a return of 6% per year and they've only been paid 1.5% to 3%, they're not going to be happy. If your bank promised you a 3% interest rate but instead paid you a 0.5% interest rate, you wouldn't be happy. If you sign a new contract with your employer for a $50,000 a year salary, you would not be happy if they started paying you $500 a month, because that's just not really acceptable. So we can split this class action lawsuit into two main sections. The first section is where Grant promised things to investors that he had no rights to promise. That's like me promising to you that I can live to the age of 100, when in reality I don't really have much control over that. There's loads of different things that might impact me, such as illness, pollution, accidents, so many other things that I can't really control myself. The second part of the class action lawsuit is where Grant has potentially misled investors about how the properties were actually financed. This could constitute mortgage fraud, but I don't really know because I'm not a qualified mortgage advisor. I'd be really thankful if someone could leave a comment below letting me know the legal standpoint on this. Now with the first part of the class action lawsuit, it starts by saying how Grant promised returns of 6%. Now this is really difficult for Grant to promise, because obviously he can't really control if the tenants pay their rent and pay it on time. He also can't really control the vacancy rate and if new tenants come and stay. He also can't necessarily control if he can purchase the properties fast enough and get them tenanted quick enough. And we obviously saw from those SEC filings that returns were definitely below what was promised, between 1.5% to 3.5% and not 6%. So Grant has obviously so far under-delivered on those promises. Grant then promises a 2x to 3x return after 5 to 7 years. Again, this is really difficult for Grant to promise because he can't be 100% certain or 100% guarantee that the property market will double, if not triple, in only 5 to 7 years because there's so many external factors that influence it. He also appears to mislead investors by promising that Grant is responsible for the debt, not the investors, which I guess is kind of incorrect because it's the fund as a whole that pays for the debt, not just the money that Grant put in himself. Misleading investors in this way is obviously not a good thing, but I don't think it's the end of the world for Grant because he can obviously just pay a higher return in subsequent years. I think if this part of the class action does progress further and Grant loses in court, I don't think the repercussions will be too big, and it's likely that Grant will just have to pay a penalty and kind of true up those investor returns. Obviously Grant might then end up making more as time goes by and himself come out on top in the end. Interestingly enough, Jordan Belfort, or the Wolf of Wall Street, actually called this a while back and said himself that actually dealing with non-accredited investors is pretty tricky stuff. But the second part of the class action is where it gets really interesting. Grant said in his offering documents that he would locate properties owned by third parties and he would arrange the necessary mortgage financing before buying those properties. From this offering document, I would assume, and again, it's only my assumption, but Grant would find these properties from a third party, such as maybe a house builder or a different investor, and he would arrange the necessary mortgage financing with probably a reputable big bank. But in reality, Grant actually purchased the properties himself, maybe in a separate entity, before selling them to the fund later down the line. It's currently unknown whether Grant purchased these properties for an amount and then overinflated the value before selling them to the fund. Now, if this is what's happened, that's obviously really unfair because it's quite unlikely that you could have bought a property on, say, January the 1st and sold it a day later for $2 million more. It's unlikely that the property would have inflated in value that much in such a short time frame. But obviously I don't know, that's just a potential what could happen. On top of this, Grant actually lent his own money to the fund to purchase those properties, and therefore Grant is the one getting paid interest, not a bank. Also, if we draw this up on a whiteboard, we can see that actually Grant isn't out of pocket at all for this. So Grant starts by buying the property for 60 million. He uses, let's say, 20 million of his own money and 40 million from a reputable bank. Grant then also lends the fund 40 million so that they can buy the property from him, using the 40 million loan that Grant provided and 20 million from the investors. Grant then actually gets 60 million from the fund. So in total, Grant spent 20 million to purchase the property, 40 million giving the loan, which is 60 million, but then he got back 60 million himself. So actually, he's not out of pocket a single penny. So not only is Grant getting a 1% fee on entry, 1% yearly management fee and 1% fee on exit, but he's also earning 6% each and every year on that interest. It's also not stated at what percentage rate Grant used to borrow the money. If Grant's obviously borrowing the money at say 4% but then charging the investors 6% for that money, that's also not really fair. Now, if it turns out that Grant is selling these properties to the fund for a lot more than he bought them for, it could be determined that he's flipping the property in a short time frame. Obviously, he's the one lending to the fund, not actually a bank. But I guess Grant would still have to be a registered lender to lend to the fund, and therefore it could potentially be considered mortgage fraud. But I don't really know on that point. That's only a guess, and I'm also not a qualified mortgage broker. It could also potentially be considered accounting fraud, because if it's determined that these properties were actually overinflated values, then obviously that's not a good thing. Although I guess the problem is that with property valuations, it tends to be a judgmental accounting policy, not a policy that's set in stone like money held at a bank, for example. It's kind of a guess at a value, not like an absolute written down value. If Grant is found guilty of fraud from this lawsuit or any future lawsuits, that could definitely land him in some hot water, because obviously the penalties for fraud are quite severe and there's quite a large jail sentence that goes with that as well. But obviously that's only a possibility. So far the class action is only to do with misleading investors and there's no mention of fraud in that class action lawsuit. As always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding the notification bell, because that way you'll be alerted when I upload a new video. Cheers!